Back again with another. I am on a roll, looking for the on a roll. What is your possible goal to scroll? I do it. Calm down, dip. DIP. Yo, guys. Thank you for tuning in. Your Zed. Guys, if you're new to the channel, please hit that subscribe button. You don't have to listen until you're ready. You understand? But knowing that these videos will be here for you when you want to come back and listen to my voice. Anyway, so coming from CoinDesk, who is the author for this? Chris Hayes and Chris Ostrowski. This article is written on January 27, 2023 at 11:30. They even posted the time. Anyway, so the title of this article is Banks Will Dominate Stablecoins and two other predictions about the future of money. Usually, I don't read predictions, but because it says opinion, it's okay. Everybody have their own predictions and stuff. I like to focus on the facts, but you know what? In the sake of reading, let's read. Crypto, rather than blowing up traditional finance, is making the existing system more efficient, and that's what CBDC and most crypto is gonna do in the competition against Bitcoin and other decentralized, more decentralized form of the blockchain. Right? So let's dive into this article. Let's see what juice we can bring up out of this. A little bit about the article, as you can see, about the authors. Sorry, as blockchain technology continues to develop over the coming years, cross-border payments will prove to be a game-changing use case. In order to grow the industry, needs users adoption, while users will embrace a technology that fills an actual need. In many respects, stablecoins are the most useful innovation to come from crypto to date. The company that finally builds a Web3 based application with a Web2 user experience will win. In the realm of payments, that means being able to harness the benefits of crypto, high speed, low cost transactions while meeting all the stringent regulatory demands the United States and Europe has over money transmitting business. Sorry, guys, for that pause. So, Chris Hayes is a senior government relations executive focused on financial regulation, and Chris Ostrowski is the chief executive officer and founder of SODA. This article is part of CoinDesk Policy Week. So, going to give credit to these guys. Thank you guys for writing up this and sharing your knowledge on the blockchain and the crypto industry and adoption of it in general. So anyway, back to the reading. Increasingly in these jurisdictions, it looks like the players set to capitalize most of its arena are regulated financial institution, i.e. banks, rather than blowing up the traditional financial system. Crypto is making the traditional financial ecosystem, I just put that eco in there, significantly more efficient. This has happened before. At the dawn of the first wave of digital disruption, fintechs were predicted to eat up and replace existing institutions. No, Bitcoin was food. Anyway, I didn't just call you food. Figure of speech. Anyway, instead of the banks integrating the software that supposedly threatened them, either by acquisition or osmosis, based on the trends we've seen through engagement with central bankers and policymakers on the landscape for stablecoins and central bank digital currencies, otherwise known as CBDC, in Europe and in the US, we make the following three predictions. Guys, they make the following three predictions. I have nothing to do with this. I'm just reading. Anyway, first prediction: fiat-backed stablecoins will continue to dominate developed markets and therefore the remittance market, while other stablecoin design dropped by the wayside. Well, of course, they're going to drop by the wayside if they have no use cases. They have to have use cases that people will buy into. Remember, the golden hands are the people who are using this tool and technology, right? So anyway, private stablecoins exist currently in two types: fiat-backed stablecoins, which are on-chain tokens backed by off-chain cash or cash equivalents in a bank account, and non-fiat backed stablecoins, which are either pure algorithmic stablecoins with no backend reserve or other designs backed by various levels of on-chain collateral. Both stablecoin types remain outside of regulation except nuisance, how do you pronounce this word? Policy regimes coming into force in the European Union and UK. So algorithmic stablecoins use self-regulated mechanisms to keep their private stablecoins pegged to another currency, a system that has had a rocky history. Typically on-chain collateral consists on on-chain, sorry, typical on-chain, typical, this is how I do it in the studio when I'm messing things up. I just keep repeating it. So typically on-chain collateral consists of cryptocurrencies like BTC or ETH, Ethereum, fiat-backed stablecoins like USDC or USDT, and a few nuisance traditional financial assets brought on chain. For example, there is a tokenized money market fund on Stellar. I love saying that word, Stellar. A tokenized green bond on Ethereum, and some other efforts like tokenized traditional financial assets. So the collapse of Terra's USD, a pure algorithmic stablecoin, has had a significant impact on the global stablecoin market. First, and perhaps most importantly, it has likely doomed any other type of algorithmic stablecoin from establishing a similar amount of trust. Terra's highly publicized failure has not only stirred intense political backlash against stablecoins generally, but serve as an example of how these self-stabilizing mechanisms can be knocked off kilter. I don't know what kilter is, but this was a lesson about functionality we didn't learn from Titan slash Iron, which failed before Terra and FTX and all these other foolishness. Anyway, so back into this prediction juice. Second, algorithmic stablecoins that are non-fiat backed but also not pure algorithm based face significant political and regulatory challenges. These designs, as currently structured, fall short of meeting the current liquidity expectations of prudential regulators in the EU and the United States. So, third, fiat backed stablecoins feel familiar to prudential regulators. They seem relatively simple to understand, and unlike collateralized designs with on chain assets, present a more conventional risk profile. While fiat backed stablecoins may have their own risk around lack of transparency behind their collateral holdings, prudential regulators can address those through regulations and enforcement. As a result, the emerging stablecoin regulatory frameworks in the US and Europe have already or will likely in the future make it very difficult for non fiat stablecoins to exist. You hear that? Or be utilized for payments. Now, guys, I know I'm reading a lot, but take a hear to all these words now. And I know this is predictions, but it got some most of what they're talking about makes sense. This will render them much less useful for payment applications, including remittances, which generally flow from developed countries to developing countries. And that is true. As we've seen, the new markets in crypto assets, MICA, regulation in the EU, Europe, makes it impossible for a non-fiat backed stablecoin to be marked as being pegged to the euro without it holding audible significant reserves in off-chain bank accounts. And that's good. I like that the system is tightening up, right? When it comes to regulating the real use cases. Because I remember a point when crypto the many crypto so-called use cases solutions to use cases were like 1,000, and then you blink and it's at you blink and it's at 10,000. It's like, wow, how many of these joints are real? You know what I'm saying? So anyway, while there are ways to navigate around these regulations, it makes it harder to compete with those players that can operate within the regulatory framework and provide the expected safety for users. So, similarly, a proposed stablecoin bill in the U.S., which was discussed last year by the House Financial Service Committee Chair Maxine Walters and then ranking Republican Patrick McHenry, would impose a um, moratorium, I think I said that right, on all new non-fiat backed stablecoin releases in the United States until the release of a report from the U.S. Treasury Department hobbling any new stablecoin entrants. Moreover, it's likely, you see, remember in one of my prior video where I said they're gonna right now we're at the stage where they're still fighting it, but they're starting to adapt, right? So they're obbling new stablecoin entrants. Moreover, it's likely the Treasury would recommend restricting stablecoin use after its evaluation and report concludes, right? These regulatory frameworks makes it clear the direction developed markets are headed and how sorry, prudential regulators view stablecoins. Oh my God. I hope I'm not brutalizing this. As you can see, I'm almost done. I just have to read half of what I just read a while ago. Oh my goodness. Why did I start reading this article? Guys, stick around. Please don't lose interest. Oh my goodness. It's over 11 already. 11 minutes. But we're gonna continue this. You know, we are saying after this I'm gonna have breakfast. I'm gonna wrap it up. I'm not gonna do it anymore. I'm just laying in bed right here and I'm reading. And this is what I would be doing by myself. But I decided to create this channel and share it with people. And YouTube keep hitting me with all these copyrights and all these things. I don't understand YouTube. All me I do I read YouTube. And your sister me I show you who write the article. And me I show people why go on. You see me I say I get a full credential to the video them some of the know why YouTube I go on with it. You see me I say. So anyway, retail CBDCs are viewed cautiously in the US and Europe, while wholesale CBDCs continue to grow. You hear that? There's a difference between the CBDCs, same as what XRP and Stellar is trying to specify, right? Stellar is saying that we're going after the people who are not banked to get them banked. Uh, Ripple is saying that we're going after the banks. Okay, so China's determined pursuit of the central bank digital currency, colloquially, colloquially, is this a new word? I need to find the definition of this because I never hear this word before. Collo, colloquially. So what does colloquially mean? Colloquially mean in the language of ordinary or familiar conversation. In the language of ordinary or familiar conversation. The accent, like you can use another word. So anyway, central banks and policymakers. So where they live. China's determined pursuit of the central bank digital currency, colloquially known as the digital yuan, is a case as a cause for not for concern for central bankers and policymakers in Europe and the US. While it's difficult to assess the effectiveness or usage of China's CBDC is very ex, existence its very existence represents an unknown challenge to the established monetary order. I have to go eat breakfast, man. I'm here and I'm breakfast probably getting cold. Other countries, including the Bahamas, Nigeria, and Jamaica, have followed suit in launching a retail CBDC and have found adoption to be the biggest barrier to usage. In other words, promises to financial inclusions and digitalization the economy are not yet to be made good, as not enough citizens have used the CBDC. No shiznit, especially Jamaica. There's a lot of people there that would never use banks, much less a CBDC. So you have to show the people like the solutions to their problems before they can even adapt the use cases. Most people ask, "Why don't you have a bank account?" They say, "Why am I gonna get a bank account that I'm gonna pay the bank to store my money where I could just keep it?" Right? So when people know, say, "Yo, you can put this, trust us, put your money here. We're not gonna take no money off of you. There's no monthly fee unless you use it." Right? So then I guess you can find people like that. So future retail CBDC pilots and launches will focus more on use cases that are unique to this particular form of tokenized public digital money. Without clear benefits, citizens will continue to use cash, commercial bank money, or e-money in both more developed and less developed economies. Public policy discussions around CBDCs will continue to be dominated by political charged issues such as privacy, anonymity, anonymity. I never, I never could pronounce that word, but I'm happy I'm seeing the spelling. Anonymity, cybersecurity, and government controls. Less publicly, many central bankers will continue to explore how they can figure how can they, how can future proof their currencies from the threats of the yuan currencies and big tech actors moving into the payment space with their own tokens. A combination of use case testing, cross border settlement, and smart contract enabling payment innovations will become public in 2023 as this work continues. The political environment makes it very unlikely that traditional banks would be willing to become virtual wallet providers for the central bank, which presents a political obstacle to adoption of retail CBDCs in the US and Europe. And as I said before, this is something that they're looking into. It's funny that I can literally talk, I can bring up all these talking points. And then when I read it, I realize that a bunch of people are thinking the same thing too as well. Wholesale CBDC holds significant promise and offer blockchain-enabled atomic settlement between central banks and financial institutions in any given countries. So in any given country, there's much hope that 2023 will finally see a wholesale CBDC solution for cross-border payments, perhaps spearheaded by the Bank for International Settlement, otherwise known as BIS. Though there have been false drawns before, back I didn't even know nothing about no BIS. You understand? CBDC and reading about these things. God, I know them now. Well, I don't know them, but I know of them. A globalized wholesale CBDC regime spanning Europe, the US, and Asia could revolutionize the banking sector and provide an innovative role for private stablecoins backed by traditional banking institutions as long as there is international coordination on regulation. So, third, this is the last one and we are done, baby. You get to go eat some pancakes, you know what I mean? I say, and drink some milk, you hear me? I say. Anyway, third, traditional banks will dominate the stablecoin market once there is regulatory certainty in developed markets. Of course, they're going to dominate for now. This is a prediction. For now, of course, they're going to dominate. But once people are, listen, people are lazy. You hear that? People are lazy and people prioritize. Let's say people can be lazy and people prioritize things differently. So you think anybody want to go walk into a bank and stay in line in minus 20-degree weather? Maybe in the summer, but not in the winter. I'm going to be swiping, baby. Anyway, traditional banks will dominate the stablecoin market once there is regulatory certainty in developed markets. We'll see. With increasing regulatory pressure towards fiat-backed stablecoins, the potential development of wholesale CBDC in the U.S. and Europe, the phone just shut up. Phone is like, "Yo, I've been warning you that your battery's gonna die soon, bro. You're not listening. Now we gotta shut off the lights." Anyway, I've gotta read fast. And Europe, US, so CBDC in the U.S. and Europe, as well as a consumer flight to safety in the crypto market. The market is ripe for traditional banks to dominate the stablecoin market. Once regulatory certainty is achieved, traditional banking institutions will be well set up to enter the stablecoin space. Traditional financial institutions have a leg up considering their existing compliance and legal functions, and may even have support from the banking regulators in pursuing stablecoin businesses. Plus, with their retail customer accounts, banks have a built-in category of users for stablecoins because of the regulatory moat and existing infrastructure moat. That's a good word for use for Scrabble. Existing infrastructure banks, stablecoin efforts would have lower funding and customer acquisition costs compared to the newer players such as USDC issuer Circle. And just so you know, Circle is on Stellar. Bam bam. Anyway, and they have every incentive to drive more revenue to themselves and payments conducted on blockchain rather than through established payment networks like Visa and MasterCard. Yup, you preach it. While the EU finalizes the MICA regulation and works on the digital euro, we'll start to see European banks enter the forefront in entering the stablecoin space in Europe. My bad. There has already been significant involvement in blockchain from players including BNP Paribas, Deutsche Bank, and Societe Generale. Yo, forgive me. Anyway, in the U.S., a policy priority for the Biden administration and Representative McHenry, now the chair of the House Financial Service Committee, is to find a path toward forward on stablecoin regulation, given its direct impact on traditional financial systems. So the battle continues. The battle continues on whether only traditional banking institutions will be able to issue stablecoins, and that, along with the tight political margins in the House of Representatives, makes it unclear if legislation can move forward in the next 2 years. Once it does, expect the traditional banks to be unleashed in the stablecoin market, and stablecoin payments can be an option from your bank account sometimes this decade, guys. So by 20 what by 2033, thanks son, I'm gonna be up in there. I'm gonna be up in my age by then, you know what I'm saying? But I don't mind. I'm living life. I'm not rushing anything, day by day. Take it day by day. Stop watching these markets. Stop, sometimes it's good to just leave this space because there's so much information here. You understand? The best thing is to do is just focus on all the investment, life investment, not just financial investment, but spiritual investment, how to eat to live investment, and physical investment. You know what I'm saying? Enjoy your life. Stop rushing and wasting your day dreaming about the future when all of this is implemented. And focus on today. Today. All right, guys. So take care. Thank you for tuning in. Thank you for checking out. Thank you for your time. As my phone tells me, I have 4% left. Perfect time to get up out of my bed and prepare myself for breakfast with the family. All right. Take care, guys. Later.